Welcome back. Today we're going to talk about wealth management and specifically what is a wealth management account. So let's go back and explain first what a mutual fund is. A mutual fund is you're hiring a investment manager. So let's say he works for either, let's say Fidelity or Vanguard or what have you. And it's his job, he takes your money, smiling because he likes doing that. And he's got people that help him. He's got analysts. And what he does is he picks a portfolio of stock. And there's different types of mutual funds. There's large company mutual funds, there's mid, small, international, bonds. There's even money market or cash mutual funds. So many different types of mutual funds. This example is a large company mutual fund. So all this guy is doing with his helpers is buying big companies. So let's say he's buying McDonald's, he's buying Microsoft, he's buying IBM, he's buying GE. Probably not a good idea right now, but so basically he's buying a portfolio of stock. Now one of the advantages is if let's say GE goes out of business, we didn't lose our shirts, we didn't lose everything. Now in the end, all fund families seem to do or tend to do similar perform. If I'm in a large company mutual fund, if I'm in at Fidelity or Vanguard or what have you, they're all going to perform relatively similar. Maybe one year one does better, one year one does. There are some that inconsistently perform over a long time period, but they're all going to be somewhat similar. So, what wealth management is you're getting rid of this guy, getting rid of this guy. And you're bringing in this guy. What he does is he takes your money and he's going to build a portfolio based on your risk tolerance. And what he's doing is he's doing typically stocks or ETFs. They can do mutual funds, but majority it's going to be ETFs. Now he's going to charge a fee. And fees can average between 1% to 2%, but for this example, let's say 1%. Now you're paying fees in your mutual funds, okay? So you're going to pay fees between, 0.65 as high as like 1.95, particularly if it's an international or emerging fund. So you're going to pay the expenses. Now there's some additional administrative costs, which may be averaged to about 0.47. So when you do the math, the expenses are pretty close, pretty similar, but you have a advisor that's guiding you into the right portfolio. And typically you can have more access to more investment options being stuck with just one particular fund family. Plus you're not on your own, doing it yourself. And most of the time in wealth management, they're going to rebalance your portfolio. Because ultimately in the end, what this guy's doing is he's going to make you more, and typically wealth management do about 1% to 2% better performance-wise, and your expenses may be a little bit higher. But the goal or the best part about wealth management is really the risk management. So for example, when the S&P was down about 30% at the bottom of 2008, equivalent wealth manager accounts were down around 11%. So when we make our money investing, it's really from the asset allocation. How much is large, mid, small, international bonds, cash, what have you, and there's subs as real estate, many other categories. But it's really this percentage, how you're allocated is what's driving your return. So this is Nobel Prize winning Harry Markowitz stuff right here. So 96 probably to 97% of that return is how you're allocated. That's what's driving performance. So this guy is very valuable because his job is to make sure you're in the right mix, to rebalance it, to do right by you. So versus, buying mutual funds, this is a better way to go because you're getting more, risk management and performance should be a little bit better. So hopefully this is a great explanation of wealth management. Think it's a better way to go, and obviously you want to find an advisor that you feel comfortable working with, an advisor that's been experienced. So thank you for tuning in, and look forward to seeing you again.